Hey, I'm Nate Dodson, and today we're going to talk all about inflation and interest rates and what it actually means to you. What is inflation? Inflation is the increase of purchase price, a decrease of purchase power on a year-by-year basis. What is the interest rate? The interest rate is a percentage cost that a creditor or lender charges against the money that they let you borrow that you have to pay back the principal plus the interest. Interest rates don't cause inflation, and in fact, they're used to combat against inflation. When the central bank increases the interest rate, they do it for the purpose of making borrowing money more expensive. So people borrow less, people spend less. It hopefully will reduce the amount of inflation that we've all been suffering. If there's rising interest rates, that alone doesn't cause a recession, but the fact that the GDP, the gross domestic product, is getting reduced, meaning people are spending less money. What the current definition of a recession is, the GDP gets reduced for at least 2 or more quarters. And that's happening right now. It's not just because of the inflation. It's not just because of the interest rates. It's because as a country, people are not spending as much money. The inflation rate will continue to rise beyond what the banks can control. The reason is we have had a quadrupling. The money supply in the United States has increased 4 times over the last 20 years. And what reduces the inflation actually is the economy itself growing compared to the increase of the money supply. Right now, as it looks, inflation could continue for a number of years just to get us to stabilize where the money supply and prices were back in 2000, fast forward all the way to today. So stagflation is kind of the worst of all worlds. It is a recession, meaning the GDP, the economy is going down, unemployment is going up, but at the same time, prices are going up. That's stagflation, meaning economy is bad, inflation's going sky high, because usually inflation is occurring when either, money is just getting printed without any basis or economic driver behind it, or it's happening because of, an increased demand for goods and services, allowing, supply and demand. Demand goes up, prices go up, that causes inflation. So you have both the competing money supply and demand actually affecting what those inflation rates are. Traditionally, when the interest rates go up, the real estate market softens. And we absolutely saw that the first time a few months ago when the Federal Reserve increased their federal funds rate, their primary interest rate, by 0.75%. And it was the fastest drop in the amount of real estate going through a purchase transaction. And it happens almost at a day's notice as soon as they increase that interest rate. Now, earlier in July 2022, they increased the interest rates again by another 0.75%. However, it did not have such a drastic effect on the real estate market. In fact, the interest rates for mortgages went down because the Federal Reserve was increasing a different calculation of the interest rate, only affecting more the short-term loans, where they're trying their best to not hurt the current real estate market more than they already have. Please subscribe, like, follow, and I'll see you next week.